Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsati, and in this week's Fortnight's podcast, we are joined by Chirag Doshi, who's the CIO Fixed Income for LGT Wealth India. LGT Wealth India is one of the largest wealth management firms in the country, providing the best solutions for investors and part of a global wealth management entity. And they come in with a huge amount of trust with investors. And Chirag is responsible for the full fixed income piece for all the solutions that they provide to their investors on fixed income. Hi, Chirag. Welcome. Welcome to the
Hi,
show.
hi Arjun. Welcome. Thank you for having me on your podcast. It's a pleasure to be with you.
Yeah, thank you very much. And the way we were debating on what to talk about, but then yesterday I got two news on my WhatsApp. One, ECB cuts rates, sorry, right, hikes rates, and China cuts rates.
Yeah.
Now, there has there have been many kinds of very many different behaviors across central banks, across markets, across currencies, which is impacting fixed income, and everything seems to be topsy-turvy nowadays. Would you agree with me, Chirag?
Yes, I totally agree with you, Arjun, on this. And as you rightly pointed out, that the global central banks have been behaving quite in opposite directions. As you rightly said, that ECB has hiked rates, and we have the other part of the world where China is cutting rates because it's struggling with growth issues. Also, we saw that US has hiked rates aggressively, and there are still chatter that they might go for another 25 basis points of rate hike, not in the upcoming policy, but maybe the one after that. So uh, earlier, as you would know, that the whole world was synchronized because there was a lot of trade that used to happen, but with the COVID coming in and a lot of issues between the developed world, especially the economies where you saw US and China putting trade barriers on each other, that has led to this issue where the inflation in one country and there is a deflation in the other country, and it cannot be exported to the country which has inflation, and hence this divergence according to me, and I think it should continue for a while.
Yes. Uh, Chirag, one thing investors, I think you must be facing the same questions, and I think this is largely to do with both fixed income investors, currency traders, and equity traders and investors. The spread between the Fed fund rate and the RBI rate, and the US 10-year and the Indian 10-year. Now, this is at one of its lowest levels we have seen. Now, what do you make of this? Because it's got various implications um, in that that India's the RBI is getting comforted by the spread or not comforted by the spread, and what would their thoughts be? And how does the central bank in RBI look at it, or how? And what should the markets actually? How should the markets look at it?
Yeah, that's a good question, Arjun. And we often face these questions with our clients as well. That the spreads have been so narrow that Indian bonds carry a risk, because if the US rates keeps on going up, then the Indian bonds or the Indian interest rates have to also follow. But one of the trends that I have seen of lately, especially, is that there has been a lot of decoupling that has happened because and this is because of COVID and the reactions by the central bank to the COVID crisis. I think in India we didn't react aggressively, and thanks to the central bank as well as the finance ministry during that time, we didn't open our fiscal purses. We didn't do a lot of monetary stimulation, which has helped us right now. I think inflation in India is under control. Of course, there are bouts of inflation going up, but that is due to the food prices and other seasonal effects, which are out of control of any central bank or government. And in US, the inflation reaching 9 point something and coming down. They have never seen that kind of an inflation in more than 4 decades, right? So, and in India, we had a habit of having inflation in double digits as well. But now, of course, with the inflation targeting framework put in place by RBI, has done a lot of work and has allowed India to control that inflation and keep the growth at levels which are better than any country right now in on the globe. So I think that should remain. The spreads may remain here, or it may, basically be very range bound. But I don't expect the spread or because of risk, because of inflation, or because of US rates going high, that India may have to also basically hike, or the rates may have to go high. We are much better than the other countries right now in the world, and hence we are seeing a lot of money is being pushed into India by the foreign portfolio investors as well.
Yes, absolutely. I think the way I'm seeing, if you look at the currency markets, where the yen is, I think it's at almost 10 or 12-year low, while the rupee is, while it's low, it's as the yen has been depreciating, the rupee has been rock steady at the lower levels though, but it's been steady for a while. Now, one is one observation we can see, and which you can corroborate because you're uh, part of a global wealth management entity, is that there are definitely carry trades yen dollar, and would that carry trades come into the rupee as well? I mean, is that part the is that geographically, would you see more money coming in from lower yielding currencies to the rupee and not uh, technically coming in from dollar markets?
Yes, yes, I agree with you. I think what we have seen of lately is that because the rates in India are high, but not aggressively high, and they are better than some of the other peers that we have, especially the China, and even if you look at Philippines, Thailand, etc., India has been doing much better. The rates are also stable, and we have enough reserves where RBI can also defend the currency if the need be. And hence, there is a lot of interest from the developed markets as well as developed countries to push money into India because A, you have growth, which is sustainable and reasonable, and second, you have inflation, which is again at sustainable levels, and RBI being RBI, they have been able to manage that well, and they have also shown the resolute to act if things go haywire.
Fair enough. And we have seen a lot of money coming into equity flows, but not necessarily so much into bonds. Obviously, there are two questions. One is whether RBI will hike rates more, or the second is that will the rupee continue to see some kind of um, pullback in terms of strength, where that prevents them from coming wholeheartedly into bond markets. Would this trend change in the coming year?
I think it has already turned. If you see the last few months data, we have seen that the bond markets or the bonds have also seen flows from the FPIs. Of course, not as high as what we have seen in the equity markets. Last 2 years have been a washout for the bond markets because we saw a lot of money being pulled out because of course, various reasons, including RBI hiking rates. So going ahead, expectations are that RBI may not hike from here, or there could be only one hike that can be possible. But personally, I don't expect any more hikes from RBI. I think this at this cycle we are done and dusted. Uh, Further flows are possible. One is that if India is included in one of the global bond indices, that has been a chatter since quite some time, at least 1.5 year since that news came in. I think it's a fair possibility that it may happen somewhere in the first half of next year, and hence flows would start coming in. Markets are expecting around 15 to 20 billion dollars of flow in the next year if that happens, and overall a $40 billion worth of flow if India is included in the bond indices and given a 10% weight. So I expect that flows will be better and it should continue from here on.
Yeah, that's a very interesting point, Chirag, especially the fact that you're not expecting more rate hikes from the RBI. I think to a very large extent, if you look at the markets also, it corroborates. If you look at the swaps, the 1 year is around the current repo level. So, and liquidity, while RBI is trying to suck it out, continues to, you know, come in droves because of FPIs for portfolio flows. And put together, RBI does seem to have some kind of a conflict how to keep inflation down if they're managing it well, and at the same time watch out for risk reversals globally, any kind of threats of financial instability that can come through global markets. um, Hopefully in the October policy they may not hike the rates by 25 basis points, or continue with the guidance and then keep a watch on the markets. Now, coming down to Indian market investors, so there's been a lot of change in the last since April. We have had a lot of taxation changes. So we have uh, so investors, domestic investors, fixed income investors had to contend with many things. One is the markets itself, then the changes, and have you noticed any change in behavior, Chirag, in terms of investors since April this year?
Yes, Arjun, I think the tax change for mutual funds was a very big event. And what the investors are now doing, or what we are seeing a behavior change in investors, is that earlier, just because of the tax advantage, there was a lot of pull by the mutual funds to get money and garner money. But now, because everything, or the bonds and mutual funds or the PMS or the IF become or remain on the same platform, there has been a lot of interest by the investors to move towards investing directly into bonds. Because you can control the underlying credit risk in a mutual fund. That's not there. Of course, there is diversification. I agree, but then if an investor only wants to invest into a particular rated underlying, then that may not be possible in a mutual fund. Or the duration also is not in your hands, it's in the hands of the mutual fund manager, who would take a view based on his view on the interest rate spanning out in the next foreseeable future. So better control, as well as a bit of a tax advantage, I would say, because the interest income is taxed at the marginal rate of taxation. But still, on the listed bonds, if you invest and hold it for a year, then the capital gains made on those bonds still are tax efficient. So we are seeing a lot of flows coming into the direct bond portfolios in PMS, as well as if somebody has a risk taking capability, then into the AIF.
Yes, thanks. I think to a large extent, even the diversification issues of investors investing in bonds are now sorted out, because platforms like INR bonds are offering bonds now with the private placement even at coming in at 1 lakh face value, and a lot more public debt issues coming in with rupees 1,000 face value. Now, technically, an investor can buy, say, a 5 to 6 year bonds of any rating, say a AAA if they want a AAA portfolio, or a AA plus, AAA to AA plus, or a AA to A portfolio, or A to in a portfolio of higher yield portfolio of A rated bonds where they are comfortable with the credits. They can invest in five different or 5 to 6 different bonds in various lenders, right, to diversify issuer risk and other risks as well. So all put together, I think diversification for investors, whether they want to go through a PMS or an AIF or directly also, are to a large extent sorted out by the new uh, reduction in face values of bonds, and the fact that platforms are offering bonds at 1 lakh or 2 lakh lots, or even if it's a public debt issue, even 50,000 rupee lots and other things.
Yes, absolutely, Arjun. I think what you said perfectly makes sense because as the face values have come down, and if you are a bond investor, you can pick and choose, also diversify because the lots are much smaller than what they were earlier, and plus you can pick and choose credits which you are comfortable with, um, and have a diversified portfolio which is under your control rather than basically being dependent on a third party manager, right? And I think INR bonds does that part very well, where the bonds can be sourced and also could be sold on the platform. That is also one important aspect, I believe, because that gives a lot of liquidity to the underlying portfolio, which also should be considered by the investors.
Yeah, and obviously, wealth managers like you and teams like yours with you heading it will give comfort to the investors on their own diversification through very strong information, research, and the fact that you can give them the best prices that are available in the market as well, right?
Absolutely.
Yeah. There is one more aspect we have seen is a lot of ultra high net worth money have gone into the new um, high yield, I would say ultra high yield. If you look at and if you put it in a global perspective, junk bond funds, AIFs offering 15 to 20% kind of portfolio yields, right? And what do you make of these trends? These are all maybe 3 to 4 year lock-in funds, and largely investing in private credits, unlisted, um, but performing well. Uh, and investors do seem to have a lot of faith in this. Now, is there a cap to the total amount that can be raised in this because of the absorption capability of the industry? Or if they're absorbing too much, then they can manage. Is there a risk to investors? Or is the economy supporting the whole structures of these?
Yeah, so you are right, Arjun. I mean, what's happening is that uh, investors are still chasing that post-tax returns that they were used to, right? So after having a 3 year investment in a mutual fund and that the indexation benefit, you would end up anywhere between a reasonable post-tax return. Now, if you want to, you have a habit of having those returns in your portfolio, then only way to do it is to move down the credit ladder and go towards bonds which yield in the 14 to 18% kind of a range, because if you are taxed at the highest bracket, then that's where you will end up being if you have a reasonably enough diversified portfolio. So that trend is there, and currently the economy has been supporting it, and it may support it for another 1.5 to 2 years. As you would know, that the credit cycle currently is seen favorable, but it may change depending on how the economy and the rates behave. But you cannot predict it for 4 to 5 years. So of course there is a risk, and I think investors should make a note of that when investing into such funds or papers directly. Otherwise, it makes more sense to have a balanced and a diversified portfolio based on own risk-taking capability. I mean, there is a lot of risk which is involved, but of course, the return is also significantly higher than you would get into in the normal performing credit or the sovereigns or the AAA bonds.
Yeah, right. And we also seen now, while they have that 15 to 19% range that is going largely to the AIFs and no liquidity private credit market, you also have bonds that are getting coming out. Some of them good, some of them bad, some of them with visible positive upward uptrend in fundamentals, some of them unsure, uh, and largely coming in a 3 year to 5 6 year kind of maturity, right? So in this sense, what would be your advice to your own investors and to the investors listening, or advisors who are uh, building portfolio for the clients listening to this podcast, on their investment strategies, if going forward for their portfolios?
So I would suggest that it's when if the view is that the interest rates are near its peak, it's better to lock in yields, and short term, of course, should be only used for the parking of liquidity. It's better to basically add duration in the portfolio, and the 3 to 6 year bucket makes perfect sense. Today, if I have to buy a 3 year, 4 year bond, which is a AAA, or AAA NBFC, is available closer to the 8% handle. And if I assume that the interest rates would come down 1 year down the line, even by a 50 basis points, I am making around 9.5, 10% kind of a return via not taking any risk. So my suggestion is to, if you don't have a risk-taking appetite and you are chasing returns which are in the 8 to 10% range, AAA and sovereigns make perfect sense. And with the capability of the bond platforms and INR bonds also capable of sourcing government securities in smaller lots, I think that strategy makes perfect sense because it gives you liquidity as well as reasonable returns for the next expectation of reasonable returns for the next 1.5, 2 years. Performing credits, I would not suggest to invest into papers which are very risky, with in the 18% handle, because as you rightly said, they are totally, or there is an element of illiquidity. You may not be able to sell those, and you may buy and hold. You will have to buy and hold, and there could be a turn in the credit cycle in the next 2 to 3 years, which we don't know how it may pan out, and there could be, you may be stuck with such papers. So it's better to have a balanced approach in the portfolio, take risk which your portfolio permits you to do. I don't recommend to entirely invest into one category. It's better to diversify and have balanced returns coming out of fixed income.
That's very sound. And platforms like INR bonds, we 100% are listed bonds, so which have traded in the secondary market. Government securities, GSECs, SDLs, treasury bills, these are all will are part of offerings of platforms now. And investors should be able to invest in a mix of corporate bonds, government bonds, across ratings, across ticket sizes, through platforms like ours. And obviously, more, investors would look to wealth managers like Chirag for the best advice possible on their portfolios. And very happy to note that INR bonds and LGT are working very closely together to support them on the liquidity for the bonds and transactions and as prices, etc. And they provide both the advice and the portfolios to investors. Anything else you want to add, Chirag? And been a very good session with you. Very good takeaways for investors. Would like to hear your conclusive comments.
Yeah, thank you, Arjun. I think it was a pleasure to be with you on this podcast and share my thoughts, and also, basically know about INR bonds and the availability of products across the credit spectrum, right from the sovereign to even bonds that are rated lower but listed, secured, etc., which becomes a very good diversification for the portfolio depending on what yield one is chasing. In conclusion, I would like to maintain that it's the time to invest and consider fixed income or bonds as a part of your portfolio, because the interest rates are near its peak or at its peak, according to me. Building a bond portfolio right now makes perfect sense. One should not wait for the peak to come, because then the you may miss out on the rates that are available right now. And in the next 1 to 2 years, we definitely would see that the interest rates would be coming down globally as well as in India, and hence your fixed income investments would give you better returns than except the of course the coupons or the interest that are received. There you would also be experiencing capital gains down the line.
Thanks, Chirag. And once again, thank you very much for coming on to the podcast and helping us reach out to providing very good information and advice to investors from experts like you who manage a very large amount of wealth for your clients. Thank you once again.
Thank you, Arjun.